All right, everybody, welcome back to the channel. What we're doing now today is the second session after a few months away from each other, apart from each other, because I did the TPFB unit a few months ago, and then I have to go into the MATS units because so many students were doing the MATS exam. So I thought I can leave TPFB for later because this exam you get the results instantaneously, and you also remember this exam will count for 15% of your level 3 qualification. Most of the students do find this an interesting subject when it comes to tax, VAT. Oh yeah, it's going to be fairly straightforward. You also have to remember in this exam you have an access to a reference material where you can find most of the information required for certain questions. Some of the questions you need to know the numbers by your head. Some of them you can refer to your reference section. This is one of these exams you can actually pass with just the reference material, not like getting really high score, but you can pass, you can break even there. And this is that sort of exam where you can put your wits end to your test, because it's about how to reference information from the given material. And also you have to remember one more thing is about this exam. Since VAT is the indirect tax, you also will be doing a little bit against about the payroll, about the FPS and EPS, and the payroll liabilities, how the fines, deadlines. Those are the things that unfortunately I wouldn't have be able to cover it, because this session is my last session for this year, because I'm away from next week onwards, and unfortunately this is the only option I have. And if you like to, you can watch the YouTube channel for the feedback of the practice assessment 1 and 2, which I have uploaded already, even though they are slightly older financial act, but the underlying concepts are all same. And on top of that, guys, I have a bit of a request for you. We are almost at 2,000 subscribers. I've got about 1,870, so I need 130 more. We need another 5% push before the end of this academic year. If we can hit 2,000, it will be a huge cause for celebration. Just to let you know, if you can like and share, and the videos, once I uploaded it, share with your friends, and just ask them to like and subscribe as well, and that will help me immensely with the rest of the contents. Hopefully when we start the new year, we will have the new FA. We can go through some of that in the following chapters, and also we'll be able to look into level 4 contents, which I'm planning to do from next year. So I'm going to have some time preparing for them, and can have some session with some of the tricky subject people may face on level 4. If you decide to do level 4, there will be some session associated with that as well. One of my colleague also planning to do some of the level 4 session. Hopefully we'll do that way. Okay, now let's get into some of the slides. Before you do some practice questions, I have papers, we can bring it up and check up online. I have resources from Kaplan and also from Osborne's, which I haven't said on the slides yet, but they are from Osborne books as well. So here, the VAT accounting schemes. What is the VAT accounting schemes they're talking about? The standard VAT is paid quarterly. Every year you do a quarter, so that means there will be 4 different times you do the VAT return and make the payments toward the VAT liability. And some businesses do have an ability to claim special accounting schemes, such as annual accounting, cash accounting, and flat rate. Okay, so some of the information you can see here. You also have to remember some of the accounting you can do in conjunction with each other, but it doesn't sometimes go together with the other account. Okay, so you can do certain together, like annual accounting and cash accounting, but you cannot do with annual accounting and flat rate, or cash accounting or flat rate, or all 3 of them together. You can do a couple of them, and it's very restricted which one you can do. Okay, we'll check into which one are they. Okay, some of them are and some of them aren't. Give me 1 second, please. So these are the normal the VAT return periods. HMRC has spread this among to 3 different stagger groups. So you can have 31st of Jan, 28th of Feb, and 31st of March. So this way there are 4 VAT returns, but it's over 3 different stagger group. Normally submission date, it needs to be within 1 month and 7 days after your VAT return period. This is when you do your submission. And also you have to remember, returns must be normally filed electronically, because this is what they call MTD. So if you went to that AAT or the Countex seminar or the get together there, you probably see MTD is very prominent because it says make tax digital, like MAGA in USA. Donald Trump saying, "Oh, make America great again." So like that way, they put MTD, make tax digital. So it is a kind of a slogan, HMRC trying to get people to do everything electronically, which is a lot easier for them to have everything connected in one central server. When it was done manually, it's a lot of things can go astray, missing. People do tend to use that to their advantage, trying to delay their payment here and there. But when it comes to electronically, you get a little bit of leeway, but you will be flagged up if you haven't done something on time. So here, payments must be made electronically, cleared the HMRC bank within the same time limit as a submission return, 1 month and 7 days. But if you pay by direct debit, you get extra 3 days. Okay, so please remember that extra 3 days only if you pay by direct debit. That means they have requested, HMRC already set it up, the direct debit, to take the money from you, so you can have up to 3 extra days deadline for that. If the repayment of VAT is due, input tax exceed output tax, this is usually within 10 working days of HMRC receiving the VAT return, you will get the money back to you. Payment must be made within just 1 month of end of each period. If you do something like a user's annual accounting scheme is required to make monthly payment for the compulsory for large businesses. So we will have those information we see later. So the three schemes are, one of them is an annual accounting scheme. Next one is a cash accounting scheme. Third one is the flat rate scheme. The first one return per year when it comes to annual accounting. But that one return you do after the year end. You get some time for that. We'll explain to you later. But before that, you have to make 9 evenly spaced payments in that year and one payment to make up whatever the shortfall or whatever the overpayment. They work it out, and then they make one consolidation payment after the end of the first year. And this one, what it helps you with, reduces the administration. That means you don't have to do a quarterly return. You do only one return, but you have to pay 9 times 1 year and then one for the following year. We'll see that in the timeline how it looks like. Then the cash accounting scheme is account basis on cash receipts and cash payments, not the invoices. That means when you make a sale on credit to a customer, normally you record that VAT on your sales day book. On that sales day book, the VAT goes into the VAT account and you're liable for VAT from that time onwards. When your invoice has been sent out to them, the tax points almost start, say if it's within 14 days. Okay, so the invoice date will be the tax point. So if you credit terms are more than 1 month, like 60 days, you still end up paying the VAT sometimes early than when you're receiving the money from your customers. So therefore, cash accounting, what it does, it stops that cycle. What it does, you only get paid when your money is received from your credit customers. And this also reduces administration because you don't have to do the VAT return on your sales and purchases. Only when you're paying them, when you enter them in the cash book, you automatically pay the VAT at the same time or claim the VAT at the same time when you're receiving the purchase from or when you're paying to your supplier. But in this way, you do have an option of automatic irrecoverable debt relief. That means when we said above mentioned earlier, when you do the VAT on your sales day book and in your VAT control account, you will pay the VAT, and then in case your customer doesn't pay you, you claim some sort of a bad debt relief when you do the write-off of irrecoverable debts. But when it comes to cash accounting, since you only pay the VAT when you receive the money from your customers, when you don't receive the money from the customers, you don't have to pay the VAT there. The VAT you charge, it's automatically as recovered from the account. So that means that's get automatically written off. Only the net amount will go as a loss to you. The third one is a flat rate scheme. Here it is charged on the percentage of taxable sales. So in this scenario, input taxes ignored, you can't claim no VAT back from your purchases. Again, it reduces administration because you're only going to account for whatever your taxable supplies are. And then also it may reduce your tax overall, because you may get a discount on the first year. So you probably pay a little bit less VAT back to HMRC. So the annual accounting scheme, the aim of scheme is to help the smaller businesses by reducing the administration burden. Only one VAT return has to be submitted every year. Regular payment on the account are made to ease the cash flow. That means if you have £10,000 from the previous year, the VAT return, what do? You pay £1,000 9 times. So you would have paid £9,000. By the end of the year. So at the year end, you calculate what was your actual VAT liability. Say if your VAT liability is now £10,500 for this year, because you already made £9,000, you only make one payment of 1,500 is to finish that last year's VAT liability. Then now what we do, the next year, instead of paying £1,000, now you pay £1,050, because your previous year's liability was £1,500. Therefore, 1/10 of it is going to be £1,050, which you will pay for 9 months, and so on, so on, so. But it helps with the cash flow. Instead of having to pay one big VAT payment at the end of the year, you have to make payment on account until you pay most of the amount off, with leaving with only a small portion left to be settled at the end of the period. And this one is another way to look at it. The VAT return submitted within 2 months of the end of the annual return period. 9 interim payments paid on the account, normally between 4 and 12 months of the return period. The monthly payments based on 10% of the VAT liability of the previous year. We will see some questions on that one. Balancing payment paid within the VAT return submission return, which is 2 months after the last day of the period. All payments must be made electronically at the end of each month, with no extra 7 days given to the electronic payment. So remember, guys, this one, has to be done on time, because you are making different cash on account payment. It is not a VAT return you do every month. It is only one VAT return at the end of the period. Therefore, whenever you're making the payment on account, you must pay that by the end of the month. Next one. Who can join? Because this number is slightly wrong. I'm not sure about this, but you will find that information from the AAT website. Let me just quickly check the AAT website whether the reference material is there. Give me 1 second, please. I'll show that to you how it looks like on the AAT website. Bear with us. Tax process. Lifelong learning portal. I'm just checking through that file quickly before we move on. Tax process. Luckily, that's the last thing I have opened, so it came up straight away there. Yeah. Let me share that screen with you. So this is the reference material you have access to in the exam. When you go in starting your exam, you'll see that on your right hand side column saying reference. When you click on the reference, it comes up with this material. So this one, it's for the exam from 27th of January 2025, which is the FA 24. Because some of my slides are slightly outdated, but it's fine. It's most of the information are similar apart from some cutoffs. So there is all the information you need. Like if you want to look for the special accounting scheme, go to page 11. So let me go to page 11. Here is the special accounting scheme. It says there, for annual accounting scheme, the maximum threshold joinable is 1.35. So if I'm going to go on back and look at my slides, I'm going to share it. The desktop is easier if I go through the desktop. It's a lot better. Okay, so let's check the slides. Not this one. Oh, it's not working. Oh, there we go. Yeah, here it is. Yeah, 1.35 million, excluding VAT on sale of capital assets. So this is the net amount, no more than 1.35 million. And you must leave the scheme if your taxable turnover for the next 12 months is expected to exceed 1.6 million. So if you join before it reaches 1.35 million is fine, but once it go past it, you can't join it. Make sure that is the point there. So people saying, okay, you can have up to 1.6 million. It is not true. It is only 1.35 million where you can join. But if your income taxable turnover increases after this threshold, you can go up to 1.6 million. But if you go past that 1.6 million, or you expect to go past 1.6 million, you need to come off that annual accounting scheme. And then what do you need to do? You have to go back to your quarterly returns. So here there are some advantages and disadvantages. We will see this. I'm going to leave that slide there because from the recording you can see that later. I'm not going to read all of that. The next one is the cash accounting, which we have mentioned earlier. The business usually account for the VAT on basis of tax points rather than not when you receive cash from account. This is what we normally do. But with cash accounting, your tax point is no matter. It's when you receive the money or when you pay your suppliers, that is where your tax point is going to be. And who can join? It is almost same rule as the annual accounting scheme. Must be up to date with the returns. Like you can't just go and join cash accounting scheme when your VAT accounts are not up to date, because you need to have no outstanding balances on your VAT account. And then also the turnover has to be 1.35 million, and you need to leave that if you exceed 1.6 million. And it also says here what are the benefits you get from there, but there are some disadvantage. If you mainly cash business, that is not good for you, because if input tax cannot be claimed until the supply has been paid, may delay your recovery of input tax. Not suitable for mainly cash sales or zero rated sales, because in that case you have to wait for your recovery of your input tax. So there are some disadvantages there. The last one is the flat rate. Flat rate account aim is to simplify the way the business calculates its VAT liability. So what you need to remember in this scenario, you only pay VAT on your full turnover, including the VAT. You don't claim no input tax. On your output tax, you pay a flat rate, say 5%, 10%, 15%, not 20, it will be less. And you also get the first year 1% additional discount there. So you still may have to issue, you must issue the tax invoices and maintain a VAT account. The flat rate percent times the total VAT inclusive turnover. That means it's also for that zero rated. So if it's going to be standard, reduced, zero rated, all of them are taxable turnover, you have to pay the flat rate on there. They're exempt, they're not included here. Exempt supplies, they're not part of this. Okay, so you have to be careful with that one. And then also there's an exemption there. Capital item costing over £2,000, I will be able to claim the input tax on that one. So exemption is the capital item. So if you want to go and look at the reference material quickly, so if I go to reference, it says to you, here you go, the taxable turnover here, the capital expenditure input tax can be recovered on individual large capital purchases from £2,000 above. So anything smaller than that you cannot claim. Anything above you can claim there. Okay, but there is a restriction on it. The amount for joining the scheme is £150,000, and you have to leave the scheme when you are earning more than £230,000. So this has the smallest of the threshold. The threshold is going to be smaller for it. And then it says here, including an exempt and taxable supplies, and excludes capital items. And then also the flat rate scheme within the type of trade is different for different businesses. It's reduced by 1% if a business joins the flat rate scheme during the first year of registration. And here also there are something called limited cost business. On that limited cost business, the tax rate is 16.5%. So this is only for certain types of business. And you can see that here, the limited cost business, less than 16.4, either 2% of the turnover, or you have £1,000 a year, because some certain business are very limited cost. Because when it comes to service industry, like somebody is going to be a plumber, he may not have a lot of expenses themselves apart from certain things. Therefore, the flat rate scheme is only 16.5%. And again, there are advantages and disadvantages there. We can look into that later. So let's look at some questions. Okay, so let's go to my trusty Excel worksheet, which I have created some questions here. So here there are good true or false question. So let's look at the first one now. See, this is about VAT accounting, true or false question. So let's say here, virtually all VAT returns are submitted electronically. That is true. At the moment, virtually means mostly all of them are done by electronically. So therefore, that answer is true. Next one, if a trader has a VAT return period to 30th of June, they must submit their returns by 7th of August. So if I'm going to remember that correctly, it's going to be 1 month and 7 days. So it's going to be what? June means 31st of July and 7th of August, which is absolutely fine. The VAT return has to be done 1 month and 7 days. All payment must be normally made on or before the time the return is due. That's the option as well. So that is also, you need to be, this is for the normal VAT accounting. Okay, it's not special accounting scheme, normal VAT accounting. Traders pay by direct debit get extra 5 days after the normal due date to take payments. That is not true, is it? Because you get 3 days. 3 days is your VAT return scheme. Therefore, that is not true. Traders who make mainly zero rated supplies usually submit returns monthly. That is not true, because that's only when you have, so there is no return, you do monthly, because whoever makes zero rate supplies, they can always claim the money back, but that is not monthly. It's going to be done quarterly. I don't know, something wrong with my glasses. Give me 1 second, please. It's maybe a bit of a scratch. Give me 1 second. About yeah, I can see now clearly. Which of the following statements about the cash accounting scheme are true? Now we're going into the special accounting scheme. The tax point for the sale is the invoice date. That is not right. Remember, cash accounting, we mentioned you only account for VAT when you're receiving the payment from your customers, not the invoice date. So therefore, this statement is false. So let me just going to draw quickly here. Let's say with this one, true, 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 false, false, false. Now next one, the trader with a taxable supplies of 1.55 million excluding VAT must leave the scheme. That is wrong, because 1.35 million is the registration threshold. Deregistration means you have to leave from there if it's 1.6 million. So you must not have to leave that, because you have the option, you can still stay there. So that statement is false. And then the scheme gives automatic bad debt relief, which we explained about, because when you don't receive the money, you don't have to pay that VAT on the bad debt. So that is fine. Input VAT can be recovered only when the supplier is paid. So if I'm going to look at that here, that is true, because you cannot claim that too early. You have to wait until you pay your suppliers, and then you can claim the VAT back with your VAT return. So that is true as well. Can you see the pattern here? True, 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 false, false. Now false, false, true, true. What is that going to be for the last one? Let's check it. The customers of the business that adopts cash accounting are disadvantaged, as the customer cannot recover their input VAT until the business pays it over. So if I'm going to look at that here, a customer of the business that adopt cash accounting are disadvantaged, as the customer cannot recover their input tax until the business pays it over. So that is true as well, because they cannot recover their input tax. Once they pay only, they can claim that back. Okay, so that is from the customer perspective. Now, let's look at the next one. There are some questions. Plenty of liquid. Agua. Suzette is a VAT registered trader. She uses annual accounting scheme and submit her returns electronically. So the year ended on 31st of July 2020. Because I'm going to do a timeline here. So here, year ended on 2020. Her liability was £9,000. In the year ended of 31st of July 2021, the VAT liability was £10,200. By which date does the annual account return for the VAT year 31st of July 2021 have to be submitted? You get 2 months after that. So the answer is going to be, in this scenario, 31st of July, 31st of August, 30th of September. The correct answer is going to be this one here. So let me round it. That is the date. But now, what are her monthly payments on account for the year ended on 31st of July 2021? So in this way, what she will be paying for year ended on 2021, she will be paying the 10% of her previous VAT liability of 9,000. So for example, here from July, so August. So it's going to be, let's say here, the first month is going to be August, September. So let's do that, September. No, okay. I'll do this way. It's easier if I do the whole month, September. Excel's supposed to be clever on this. Yeah, now it's fine. Okay, so this is the first year we are looking at. So the first payment will be on the 4th month. So if I'm going to say here 31st of July, so 31st of August, 31st of September, 31st of October, 31st of November. So this month they will be start paying £900, £900, £900, £900. Because this is the 10% of the previous year's liability. So how many payments they have made? 9 payments. So they paid £8,100 so far. But they have to make one correcting payment on the following year for the whatever amount they left, which is 10,200 minus 9,100. So 8,100. So 10,200 minus 9,000, 8,100. Okay, 8,100. So one correcting payment of 2,100 there to settle the rest of the liability. But the question is, what are her monthly payments on the account, which is ended on the 31st of July 2021, which is that day, is going to be £900 a month. That was the question they're asking you. If they ask you how much she has to pay to settle the balance at the end of next, like on the second month of the next year, which is £2,100. So let me see some more question here. This is again true or false question. Remember guys, in this exam you get a lot of true or false questions. Okay, so let's see this one now. Remember, this is the year 1, so I'm going to just put the year 1 here in bold. This is the first year. Oh, hold on, I don't want that. Yeah, this is the first year, and then you have second year. So on the second year, let me show you if I'm going to do the second year payment. How would I do it? Here in this scenario, that this year's liability is 10,200. So from November, they will be paying 1,020, and then 1,020 will be paid until end of July. And then they will find out how much is the end of that year in 2022. They will find that payment and they'll pay that by 30th of September. So this is how the annual accounting scheme works. And then the VAT return is done on that month. This is the year, the month they do the VAT return, and this is the time they will be doing the VAT return. They would have done a VAT return on this month here, for the previous year. So can you see here, the VAT return is done only once a year when it comes to annual accounting. So let's say here, the scheme is useful for traders who make zero rated supplies. No, it does not. Why? If you do zero rated supplies, you would like to claim the VAT back, not to pay VAT, because there is no output tax, it's only input tax there. So therefore they have no benefit of going into a special accounting scheme. So that statement is false. The scheme is useful as it allows the VAT payments to be fixed in advance, which is absolutely true. Can you see here? We have the amount, it's been fixed throughout that year, and then yeah. The next one is, yeah, because you can see £900, and then on the following year you have £1,020. It goes on fixed for that year, and then you make one connecting payment. Next one is, X Limited has the expected standard rated turnover for the next year of 1.4 million pounds, including VAT. It cannot join the annual accounting scheme. Absolutely. If your taxable turnover is more than 1.35 million, which is in the reference. Can you see here on the reference? It says the annual accounting, your maximum taxable turnover for joining the scheme is 1.35 million. So this one is more than that amount. So you cannot join the annual accounting scheme. If they're already there, they're fine. But if it's more than 1.35 million, you cannot join. All payments must be made electronically. Then again, this is very what is that again, the part of it you have to remember, they want you to do that electronically if you're on the special accounting scheme. If you're on the special accounting scheme, it is a necessity now, you have to do that electronically. Sometimes you can pay that by check. Yeah, hold on. So that is, yeah, the payments doesn't have to be electronical. The returns are done electronically, not the payment. Guys, see this question kind of a tricky here. The VAT return must be done electronically. The payment can be made manually. You can send them a payment by a check before the deadline. It's fine. Doesn't have to be done electronically. So that statement is false. When it comes to here, all returns must be electronically. Yes, it's true. The payments doesn't have to be electronical. Next question here. On this one. Okay, let's see here. All right, here you go. I have a couple of more good questions here. So it says here, why? Okay, I have, now I got it. Why I couldn't see it, I don't know. Ophelia is registered for the flat rate VAT scheme, and the flat rate for her business is 6.5%. In the last quarter, Ophelia Limited made the following sales and purchases. What is the VAT payable by Ophelia Limited business for the quarter? So for that one, let's get our trusty calculator out. But remember, with the flat rate scheme, you cannot claim any input tax. Therefore, only the sales including VAT will be counted for. So it's 35,244 plus 1241, and this is the total turnover, and you have to find 6.5% of that one. So if I'm going to multiply this by 0.065, this will be your VAT liabilities. The VAT liability is going to be £2,371 and 52 pence, because you round down the VAT. In this scenario, the VAT will be rounded down to that figure. Okay, so that is the accounting scheme they're talking about, the flat rate. It goes with your sales only, not your purchases. If you thought about normal VAT return, you normally find the 20% here minus that 20% there, and then you'll be fine. But on the flat rate, this one is not accounted for. Next one. there is this question here. You choose between annual accounting, cash accounting, and flat rate scheme. So HMRC operates three special schemes for VAT. For each of the following points, decide to which scheme it's related to. Tick all that applies. So here there are three options here. And can you see here? This one, which can be operated with the cash accounting scheme or the flat rate scheme. So there is a one option there. You may not be able to do it when it comes to that scenario. Okay, so let's say here which one it is and which is not. VAT is accounted for when the payment is received or made. When is that going to be? When payment is received or made, it's going to be the cash accounting scheme. The annual taxable turnover must be 150,000 or less. That's flat rate scheme. Okay. Then we'll come back to that later in a minute. The VAT return submitted once every 12 months. That is going to be on your annual accounting. Why? Because that is how you do it. No requirements to record the VAT charged on every sales. Now we have a bit of a question. Why we don't have to record the VAT charge on every sales? Because we don't need to record it, because the total turnover, it's going to be based on the flat rate. You have to still have to show them the invoice, but it's going to be on your turnover. Provides automatic bad debt relief. That is going to be your cash accounting. The VAT payments can be made in 9 equal monthly installments. That is going to be annual. The VAT is due for payment 2 months after the end of VAT period. Again, that is your annual. This one here, we have to show you what it says in the book there. So bear with us. Let me just quickly grab the book for you. It says here which one you can go in conjunction with, and which one you cannot go in conjunction with. So it says here somewhere. Let me check where it is. Special accounting scheme. It's not on the reference material. I thought it's in the reference material, but it's basically not. No, it doesn't have it here. But let me get the books quickly. Give me 1 second, please. It's in the books, which I'll be able to show you. Bear with us, please. Let me show that to you in the reference material here. Bear with us. Yeah, let me show you that screen. Let me share this excerpt. Yeah, so can I show you quickly? Here you go. This is the material here. The annual accounting scheme can be used in conjunction either with the cash accounting scheme or with flat rate scheme. So that means that one is what you normally can do with some other things. That means annual accounting can go with the cash accounting or with the flat rate scheme, but not both. Annual accounting scheme is the connecting point. You cannot do the cash accounting scheme with the flat rate scheme together, because some of the schemes you can only work in certain angle. So let's go back to the question here, which we have here. It says which may be operated with the annual accounting schemes. Those two are individually possible. For which included scheme, tick all that applies. So that means I can have more than one answer here. So here these two can be worked together with these two, but not together. All three of them cannot go together. Only you can either do cash accounting or flat rate scheme. Okay, so there are 1, 2, 3, 4, 5, yeah, nine points to be made here if you get that question. And then now we're going to go and look at the VAT return itself. So let me go back to my slides, quickly go through what is the VAT return is all about. Here you go, PowerPoint slideshow. So the VAT return, what we do when we do the VAT return, how the VAT returns are done. So one of them is we have to worry about the VAT control account, how to communicate the VAT return, and then the communicating that information there. And then the last one is adjustable. What we do if there are some adjustments, like what are the non-recoverable VATs, what is the irrecoverable debt relief we get, and the errors. People make errors, how to correct those errors, that we'll find out in a minute. Okay, so here the first one, the VAT return. In your assessment, you may have to verify the VAT return from the information supplies. There are 9 boxes to fill. So these are the 9 boxes. The first box is going to be your VAT due on sale. This is all changed now. This is slightly different than how it was in the past, because in the past it used to be like acquisition and dispatches. Now that information is different. It says they're intercommunity acquisition made in Northern Ireland from the EU member states. Remember, the biggest conundrum of the Brexit was this one, whether they're going to be a hard border between Ireland and the Northern Ireland. So therefore, the cutoff was in the Irish Sea when it leaves Great Britain to go to the Northern Ireland. But again, that is something political side of it. We're not going to be bothered too much about it. And then the third one will show you the total VAT due. So if you add these together, you'll have the VAT. And then the fourth one, what we're going to do is that VAT you reclaimed on purchases and the other outputs. And then what we do, this minus that will show you the VAT is paid by yourself. And then you have box 6, 7, 8, and 9, which is your total turnover and total expenses. And then box 1 to 5 is your VAT reminders. They are in 2 decimals up to that. And then box 6 to 9, you put the total inputs and outputs. It needs to be entered to the nearest pound. So VAT control account must be maintained to show what is due and to and from HMRC at end of each quarters. So here VAT control is part of the double entry system. The balance, you know all of it. You've been done that plenty of times before. And if you agrees with your VAT return, if not, there is an error. So sometimes if your VAT return, you fill it out and that number does not match what is the amount outstanding on your VAT control account, that means there might be an error there. If the balances do not agree, this is a sign that an error has been made. So we'll find out what sort of an error, and that is probably, you have to look into. Then, of course, you have some bad debt relief. How are you going to do the bad debt relief? There should be an adjustment. You can only reclaim bad debt if it confirms to these conditions. Your output tax was paid on the original supply to HMRC. That means it's not cash accounting, which is the normal one. Cash accounting means you claim the VAT back on that automatically because you don't receive any money from the customer anyway. But so in this scenario, on the bad debt, you can only claim back if you paid the VAT on one of the previous VAT returns. 6 months should have elapsed from the date of payment was due, or the date of supply if later. So that means if I gave 30-day credit, from that it needs to be 6 months afterwards there the payment is due. The date of VAT return, okay, whichever it is, the earliest. If you look at that here, which one is the earliest supply date? The debt is less than 4 years and 6 months old. So that means that cutoff is 6 months and 4 years and 6 months there. The bad debt has been written off as irrecoverable debt in the accounting records. We already written it off. If we haven't written it off, you cannot claim it yet. The debt has not been sold or given to a debt factoring company. That means I didn't sell that on to somebody else. Once I sold it, it's no longer my debt. I cannot claim any bad debt relief on it. And the business did not charge more than the selling price for the item. That means I may have artificially inflated the price of the goods, and then I cannot claim the VAT on that one, which is wrong. Okay. The method of bad debt relief, the irrecoverable debt relief will be added to the box 4 of the return. Normally the box 4 is for your input tax, and you will claim the VAT by adding this bad debt relief into there, so that reduces the element you pay out from box 1. To calculate the VAT on the VAT inclusive debt, you can either divide it by 6. Anyway, you know how to do the VAT calculation. If the business later received the repayment of the debt, it must make an adjustment to the VAT relief claim. So I already paid the VAT, HMRC, and I reclaimed it with the bad debt relief. Now, a few months later, the customer turned up and said, you know what, I'm paying my debt to you. What are you going to do? You may have to pay that. Not may, you have to pay that VAT back to HMRC. And then the next one is errors on the VAT return. This one is the net VAT errors made in the previous VAT returns which are not deliberate and are below the disclosure threshold can be adjusted on the VAT return. So it says here, a single input error, error of output tax will be added or subtracted on the box 1. Because if there's only one error, it's something to do with the output tax, it goes on box 1. You can either add it or take it away. If you have a single input error, it is something to do with the input tax, it can be added or subtracted from box 4. But if there are several errors, what we do, you find what is the net effect. If that errors combination of it will increase the VAT liability, you need to put that on box number 1, which is if your VAT was underpaid. Because underpaid means I haven't paid enough. That means it has to go on box 1. If you overpaid it, that means it's going to reduce your next VAT liability. You add that to your box 4 as additional input tax. Most of the time it is box 1, because most of the time they make an error. It's end up being the less VAT was paid to HMRC. But be careful, that has to be non-deliberate. If it's deliberate, that is a different scenario. Next one. A reverse charge. No, that's something you don't have to worry about it, because it is something you do that for different reason. Communicating VAT information. Okay, you may be asked to email a colleague about VAT. You give the information of the return submission in the exam. You normally get a question. Last question are based on this email, the communicating VAT information. So one of the VAT question was like that way. There they ask you about how you advise your manager of the correct payment dates, the cutoffs, the submission deadlines, and the fines. Sometimes you may get fined or penalties. You need to let them know accordingly. All of those information are in this one here. So if you go here, the late payment. So here, late submission, late payment of VAT, you will get charged for the late submission, £200. Every time you do one more time, it's another £200. And then the penalty points, how the penalty points are applied, and how to remove the penalty points. And if you make a late payment, what is the charge for that one? Then they will start charging 2% of the VAT due. And then also they can charge you interest. Please remember, this interest is Bank of England rate plus another 2.5%. So if your Bank of England rate is 4.5%, which is now, the VAT will be charged an interest on the amount outstanding as 7% per annum. Okay, 7% per annum they'll charge you, and that is something we will look into in another time. At the moment, I don't have that time to show all of that one. May have one question with that. Apart from that, you have to look at the online websites, online videos for my VAT return questions on the AAT assessments. So here, that is the part. So here, that's the end of the slides. Let's do a couple of more questions and we will finish the year on high here. Okay, so this one is about Gisborne Limited. It's a VAT registered trader that makes standard rated supplies. Gisborne Limited is preparing its VAT return For the year, the quarter ended on 30th of June has the following VAT control account information. This is the balance brought forward. This is the amount paid. So this basically cancel each other there. Okay. What we now have, this is my output tax. This is my input tax. And this is supposed to be the amount you have to pay to HMRC. So they're asking here, what is the VAT inclusive sales figure did Gisborne needs to have earned in the period in order to have the amount of output VAT shown in the control account? So here, this number is your 20%. So if I'm going to do that here, okay. Here, this is the amount I have here as the VAT. They're asking you what is the amount they should need to have earned during the period to pay that VAT. So if I'm going to do that in a sense, let's say here the VAT is 12,600. So this one is the 20%. So they're asking you the question, where's the percentage? Here is the percentage. They're asking you here, what is the VAT inclusive sales figure? So what they want you to tell you, what is the 120%? What do you need to do in that scenario? You're going to do this, divide by 20, times it by 120, which give you 75,600 pounds. This is the VAT inclusive figure, the box number B here. Okay, this is the amount they should show there, because that is what they need you to do, because what they asked you here is the 120%. If you've done the 100%, which is the net sales, and that is going to be equal to same this divide by that times that number, which will be 63,000. This is not the number they want. They want the VAT inclusive sales figure. That will be 75,600. So that is the right answer there. Now let's look at this question. This is a very nice question. I like this one. And then we have this question as well. So let's look at this first one here. I'm not sure you can read all of it very clearly. So let's, oh yeah, it's better now. This question is about completing the online VAT return for the business based in Scotland that sells designer clothes. Do you think there's a different rule for Scotland? I don't think so. They're part of Great Britain or United Kingdom. The VAT rules are almost exactly same. The tax reasons are different. Okay, the income tax out, the national insurance rates are different to Scotland, but the VAT is all same. So they give you the sales account figure here, then have the purchase account figure here, and then also they have the VAT control account figure here as well. So they're asking you here, you have been told that a bad debt relief of £264 can be reclaimed in this VAT return. And you also told the last VAT return amount of input tax included has been overstated by £403. So what you need to do here, you've been asked to adjust for this error as well. So remember, this is only one error. Bad debt relief is not an error. So there is a single error entry. So if I overstated my input tax, what happens to that overstated input tax? £403, because that one basically made your input tax higher, therefore you paid less tax altogether because you claimed too much tax back. But now this one has to be paid back. So this needs to be taken away from box 3 here, box 4 here. But the bad debt relief of £264, it gets added to the box 4. So therefore, only box 4, we need to make the adjustments. And let's see what other numbers I'm going to get here now. Okay, so here I'm going to say here, box 1, box 2, we go up to box 9. Okay, so the first one is they want you to do what is the sales VAT due in this period on sales and other output. So let's go back and here check the VAT control account. The sales VAT is only this much, 32,581.25 pence. Okay, so this is basically all the UK sales, no sales for the VAT on EU there. So the amount I'm going to do 32,581.25. So here 32,581.25. Box 2 will be 0 because there is nothing mentioned about any acquisition made in the Northern Ireland from the EU member states. So that's fine. The total VAT due is going to be this plus that number. And box 4 now, what is the amount we need to do? We look at the output VAT, which is these two numbers there, which is equal to now I can see the amount is going to be equal to 18201.76 plus 103.42 because we have to claim that back as well. But we need to make sure we add the bad debt relief. What is the bad debt relief was? £264 minus the overclaimed input tax. The input tax I have overstated, £403 has to be taken away. So the total box 4 figure is going to be £161, sorry, £18,166 and what is the number here? Yeah, 18 pence. Okay, and now box 5 will be equal to that minus that figure 1441507. So this is the total VAT due. Okay, now they're asking you what is the box 6 figure. Box 6 figure will be all other outputs excluding any VAT. So here, this one here include your box 8 figure. So therefore this all of my sales, total sales were 188,735, full number. That's it. Box number 7 is going to be all your purchases including the petty cash. So it's going to be 91526 because it's rounded up there to bring that number. Box 8 saying to you total value of sales and what is that again? Box 8 supplies excluding cost, excluding any VAT return from Northern Ireland to EU member states. Because did I send anything from Northern Ireland to the EU member states? We are based in Scotland, so there is nothing from EU Northern Ireland to EU member states, so therefore is a 0. And they are also saying here total acquisition of goods and related cost excluding any VAT from EU member state to Northern Ireland. We haven't got nothing. In the past, this one was going in that box because now it's only for Northern Ireland that applies. So we have a 0 here. Can you see? These are the answers they expect. This also I need to do 2 decimals. So I'm going to change the format 2 decimals here to confirming with what are the number we have entered. So this, if you don't do that way, you won't get the full marks here. Okay, good. Now the last question. It says here, Brixham Limited is VAT registered, does not operate any special accounting schemes. The following accounts, so I'll probably need to have the box again, just in case we keep the box copied and paste it here. So here guys, let's do this. It says here there's a purchase account and VAT control account or VAT account, whatever you say here. You have been informed the above totals include 2 items that have been recorded incorrectly. A purchase invoice of £1,736.20, which was 0 rated for supplies, have been entered as a standard rated VAT. So here there is some VAT there. It should not be. It needs to be a 0 rated. So we need to find the VAT and we have to remove it, because it's not an error from the previous returns. Okay, this is what we're going to do now. We need to amend these accounts accordingly. A VAT on non-allowable client entertaining. That means you can't claim the VAT on the client entertaining. You can do for staff and the overseas clients. Not allowable client means they're UK based clients. So that one, the amount of £872.40 including VAT has been included on the VAT account figures. So here that is part of the purchases as also here on the standard purchases. So there are two of them which are zero rated supply entered as a standard, and this is something they claim. So that means both of the VAT needs to be removed from there. Now they are asking you here, what is the VAT on non-allowable, what is the, calculate the figure for the box 1 of the VAT return once any necessary corrections have been made. Okay, so here how much is the box 1 figure? Box 1 figure is only going to be including these two. Can you see here? These are the both sales. These two are to do with the output tax. I don't need to worry. So nothing to do with the output tax. So I don't need to worry about box 1. Box 1 is going to be just the sales day book figure and the cash book figure. So the amount is going to be equal to 43,894.04 plus £1,777 and 18 pence. So the overall amount is going to be £45,671 and 22 pence. Okay, so this is the box 1 figure. Box 2 is 0. Box 3 is going to be same as the number above, so there is nothing to include. Now the box 4. So what we need to do here, a purchase invoice for £1,736.20, which was for zero rated supply, has been entered as the standard rated VAT at 20%. So we need to find the VAT on that invoice. That invoice is going to be what? 1736.20 times 20%. So this is the VAT they claim, 347.24. Okay, this is the VAT they have added on this VAT account. So that number is a bit too high. Okay, next one, this is the error 1. Okay, so this is error number 1. Error 2 is for the client entertaining. So that is going to be including VAT. So it's going to be 872.40 divided by 6. This is the amount for the second error. So let me add the 0 to it. So that way, these are the two VATs I have overclaimed in this VAT control account. But when it comes to box 4, we have an opportunity to remove those figures. So here, this number is the input tax now, 0.09 minus that figure minus that figure. So those two are automatically taken away from that number, which leaves you £51,433.45. You expected this, guys, when you're going to look at that here as well. If they bought zero rated supplies, there is a possibility they make a lot of items sold on the zero rate as well. So therefore, this is what you need to remember, how to enter that number in the system. So here, the VAT will be due to be paid is that. So you are expect to have a VAT refund. So you put that amount as the positive figure in this box 3. The number will be a positive figure is £5,762 and 23 pence. Okay, so that is the number. You go here and then you will say that is going to be reclaimed. The amount will be reclaimed because your input tax is larger than your output tax. Okay, guys, I hope this session was useful to you when it comes to filling up this information there. So let me quickly bring that video up again.